Hey everybody, welcome back to another episode of Not Financial Advice. On today's video, I'm going to be giving you an inside look at my $120,725 portfolio that I have here. We're going to get into it right after this.
You need to diversify your bonds.
The only problem you're gonna have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, guys, if you'd like the video and subscribe to the channel, I'd sure appreciate it. And today we're going to be taking a look inside my entire investment portfolio, which has just hit an exciting milestone of over $120,000. Here in early 2026, I've been investing for about 5 years, give or take. And at the end of today's video, we're going to discuss whether I've beaten the S&P 500 or not, and how I feel about that one way or the other, as well as what I see for growth in my portfolio in the future. So go ahead and like and subscribe, and we're getting into it right now. So as you can see there, the portfolio is sitting at about 121,000, and it's interesting how these things work. If we just do a recap of the last, 12 months or 365 days, as we have the Google Finance portfolio tracker here set, we can see something. We know that 2023 was a good year, 24 was a good year. So going into 2025, um, at the time things probably looked normal. Started off the year, made some gains. At one point I was up 7, 8%. And then that big divot that you see there in the screen where we went from 86,000 to 93,000, really feeling ourselves. Then we had the Trump tariff tantrum. So we had a market drawdown as much as 17%. In my personal portfolio, market went down at one point as much as about 19.9%. So it wasn't a technical bear market, which is 20%, but it was dang close. And I had some relative outperformance, which we're going to circle back to later, but I actually like that aspect of my portfolio. So that's how a year can start, just to see how the year ends. Ultimately, I believe that I performed somewhere between 16 and 18% in, excuse me, I believe that I performed um, somewhere in the range of 15 to 16% most likely in 2025. It can sometimes be like a full-time job, which is not what you want, but it's a hobby of mine, so I have fun with it. But I actually have investments across 3 brokerages, and then I manually track them here. So it's not perfect, and the number that you see here, that's not actually right. Um, because I will often, kind of remodel the portfolio every 12 to 18 months, I've been restarting, and so you have previous iterations there and there. So I'm not actually capturing the cost basis. So I had to do some back of the napkin math to sort of get a sense of my all-time portfolio performance, which I'll reveal at the end of the video. Um, but we're just talking about the big number here before we go and highlight some of the investments as I promised you. So it's just interesting to see how this, how this was. And so you have the temper tantrum over the tariffs. And at one point I was at 93. So until you get back there, you don't feel like you're making any progress. So there, 5 months into the year, this is a story of fives. So 5 months into the year, essentially nothing had happened in my mind. I started wherever I was at, and in January, February, it was a continuation of 28.3 and 24 where we had gotten soft, and I got up to 93. I was feeling myself, and then it all was taken away. I was a horrible investor, and then it took 5 months, and then I was only quote unquote up a measly $1,000 from that peak, right? 93 to 94. So in my mind, nothing happened in the first 5 months of the year. And then boom, it starts running. It ran up. Contributions and gains and dividends, 24 points, just boom, 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 boom. Constant serotonin overload. It's funny. I had 5 months of the year earlier in 25 where it quote unquote did nothing, but you can see what's happening underneath the hood. And then you have this 5 weeks here that happened. Someone asked me how my portfolio had been doing recently, and I said something in front of them. I said, I don't know, I feel like it hasn't done anything in 5 months. So that 5 months I experienced earlier, in these 5 weeks where I was flat after getting spoiled for 6, 7 months before, they're just running up weekly, it did nothing, right? But then we can see here, it just ran another $4,200 in 5 days. So 5 months, 5 weeks, 5 days. That's how money works in a portfolio. That's how compounding works, and it's something you only learn with experience when your own money's in the market, so I'm happy to share that with you guys today, excited to share that. Alright, let's dive a little bit deeper. So taking a look at the portfolio here, really the anchor of my portfolio is the total United States market. So that's mega caps down to small caps with some mid cap, but also some, kind of large cap core stocks in there as the foundation of that. So it's 3,500 stocks, every stock in America, to my understanding, weighted by their popularity or market cap or total shares times share price, which is market cap, which is the total public value of a company. So Nvidia is going to be better, bigger and better and heavier weighted in this fund than CVS, but they're both in there, if that makes sense. So let's switch to the view of the heat map. And this is only showing a 1 day, whatever. But yeah, um, looks like the total market here, it's 19% of my portfolio. It's a really nice foundation. It's kind of, along the veins of I think I can beat the market over a long time, but quote unquote, what if I'm wrong? So a little bit of that insurance. And I like that it has small and mid cap in there versus S&P 500, the most popular investment on YouTube. Small and mid cap historically over 100 years outperforms um, large cap. And so ultimately, I believe in some type of mean reversion, but I also believe in that to an extent, the efficiency of markets over certain periods of time. And so I'm happy to have the largest piece of my portfolio, about 19%, being the total United States stock market. So you can then see I have got some really heavy weightings. We'll talk about we're going to just go through them and I'll say one good thing about each one. So Amazon, I thought it was a online grocery store, but it's really the home for the internet. And so during COVID times, the online grocery store aspect was appealing to me. Frankly, I didn't even fully realize what I was buying, but I'm now happy to own not only an online retailer, but AWS, which is the home for the internet, and their growing advertising business that they have. All time 1,100 or $10,000 in that position, 10.2, up 45%. And this is the other thing, you guys, which is interesting. After such a long period of time, you can see pretty much all of my investments have had a positive return. Now, it's something when a given investment, right? We can just jump around really fast. A given investment, Coinbase, it's a small percentage of my total portfolio, you know, um, probably about 1.5%, but it's gained 220%. So retrospectively, if you could have put everything in it, that would have been better, but that's just not how real life works. One fast note on that, that had gone up as much as 3 or 400% for me at one point. It had ballooned to a $3,500 position. I had only ever put $1,800 into it. So I took 1,800, I turned it into 35 or 4,000 because I didn't believe in crypto, but I wanted the what if I'm wrong. And then I took all my money back and put it into boring index funds to run up and lock in those gains. So this is all my money is out of it plus profit. Everything that's running is just the interest, and I'm just gonna sit there and watch it forever as they custody uh like Bitcoin and Ethereum ETFs for BlackRock and eventually Vanguard maybe and State Street. They custody everyone's crypto ETFs. And so now this is kind of like the extraction economy or a toll booth company, as opposed to just a brokerage where people are YOLOing on Shiba Inu or whatever, which I never really believed in. But that's fine. So we'll get back to it here. $121,000 portfolio. I wanted a barbell in 2022. I got hurt really bad, down about 40% on Amazon, which at the time was like 40% of my portfolio. I thought I was Warren Buffett, and I'm not. And so I have what some people would call dead money, about $7,200 in Vanguard Value. And so that holds things ironically, right? Like Berkshire Hathaway, I think, is the largest investment within BTV. But then there's also um, JP Morgan Chase is in there, and then companies like Walmart, um, stuff like that, Procter and Gamble, energy stocks, which I don't know enough about and can't wrap my mind around, but I want exposure. So that's one of the things I've learned is if there's something you want exposure to, but you're not an expert in it, buy a index-based ETF, broader market, and get that participation that you want. So I think this one's like a coiled spring, only up 13% all time. But I think it could, for the next 5 years, it could go up 13% a year. And if that was the case, being my third position, I'd be in good shape for that. Small cap value, I won't say too much, but that's like home builders, regional banks, distribution centers, um, logistics companies, as it were, industrials, material companies. This is the real America. It's small and medium cap companies that are profitable. And so that's my fourth largest position. It did nothing for about 3 years and it's just started to run. It was actually my last buy. I put $250 into it. Uh, last last buy I'm going to be making for a little bit, but that's a story for a different time. So then we have Google. I didn't sell it when everyone said ChatGPT was going to destroy it, and now they're making Terranium chips, whatever the heck that is. But we spend a lot of time on YouTube all day. That's a good reason to own it. Gemini recently has been gaining ground on ChatGPT as well, and so I use Gemini a lot. I pay for Gemini. I'm on YouTube all the time. They also have Waymo, which is like a less Elon version of whatever. So I think that AV EVs are the future, but I like to take my exposure elsewhere than a company that has a single man risk. So I owned Tesla at one point, made a modest profit, locked it in, sold it, and had put it into price I'm in boring like Vanguard Large Value. So healthcare, I think people are going to get older and technology is going to get better. I think it's also defensive as well as growth in nature. It's historically done well. It's at historically low valuations. I made a big bet, $4,900 on it. So Williams Sonoma, that's ritzy upper class women buying $400 cast iron skillets. I like that. $4,700. SCHD, probably the second or tied for first most popular investment on YouTube. $4,500. It's been dead money, but it's also probably spun off over over the years, probably more than $500 in dividends, and I think it could run for the next 5 years. So I like that a lot. Netflix, uh, I I bought that and owned it when it was down 100%, and bought some more. Should have bought more, but it's run up to 100% gains. It's been as much as 150% gains. I don't believe in taking profit on that one because I think it's a long term compounder rather. State Street, DT, DT neighbor. What a time to be alive. So, I think it was a thing to buy, so I bought it, and, it's doing what it does, up 90%. That's pretty cool. That's pretty cool. So then I have, just some index funds there. I bought it strategically. I thought at one point I should have more international exposure, so I took some there. Um, and that's important, but I also have Uber, which I like subscription, I like reoccurring revenue, I like the convenience economy, and I like AV/EV, and I like the founder. So the founder of a company not being a weirdo is pretty important to me. That's had some pretty nice gains. I've owned that one probably for only about 18 months, about 23 points. This goes along with when I realized I wasn't Warren Buffett, so I bought funds that had his, company in it. I bought VTV, which featured his whatever. I think Tom Lee's brilliant. I think he might be the next Warren Buffett. Whenever someone says the next whatever, you wanna be leery of it, but this model portfolio has outperformed the market solidly 6 out of the last 6 years, and here's a spoiler alert, I actually haven't. So I've bought some of his, strategy recently, just about 2% of the portfolio, whatever, 2, 3%, feel really good about it. International stocks, I'm underweight. I shouldn't be, they're important. I have some here on a value, tilt. Visa, I like the transaction, extraction, swipe economy. I like getting paid dividends on economic activity. Utilities, they're not correlated with the stock market, but they do seem to be correlated with AI. And so there's upside and downside protection, and I can see that being good in a lot of ways. And then large value, which or large, excuse me, large total ex-US market, not discriminating against one country versus other, and many more. The taper tantrum, when things are bloody in the streets, sometimes you buy the companies that are most affected. I actually bought this during the tariff thingy because it was most affected, and now it's really benefiting not only I bought it, I think, because it was involved in the AI build out, and then the tariff thingy happened, and now we're having like a Venezuela build out and whatever else up 100% in about 18 months. Should have bought more, but not a meaningly insignificant portion at $2,400 of my $121,000 portfolio. And then Microsoft. I initially bought that because I was the first way to buy AI because they own OpenAI. Everything else is either funds or less significant parts of my portfolio. I still really believe in them, but the video is getting a little bit long in the tooth. So we'll just go through them faster. SCHG. In fact, you can read for yourself. Financials, Facebook, iPhones, which I never owned one, so I guess that's why I own less. Costco, cybersecurity, I believe it could be defensive in the future. A healthcare company, I've owned that for about a year or less. Nice 25% return, showing my development as an investor. Home Depot, it's done nothing. Now it's running for reasons. Casey's, if you know, you know. AutoZone, great historical performance. Zoetis, spinoff of Pfizer, biggest manufacturer of pet medicine and veterinary supplies. I've always wanted to own a pet food company. They've been too expensive. I found this. This is the best thing that I can do. It's my only position that's down out of about 37 or so investments. Waste management, Peter Lynch taught me. Female friend of mine couldn't stop ranting and raving about the values there. Had to own it. Should have bought more. TJX up 53 points. Berkshire, total market, the overlap's bad, but I did it for a reason. Cintas, uh, they do aprons for like mechanic shops and restaurants and data center build out places. They're an industrial. They wash people's uniforms. It's a great like technology take on industrials, and then large value, whatever, whatever. One of my first investments actually ever was VUG. That's been pretty good. I've trimmed it off and sold it multiple times, and now I just can't figure out a way to sell those fractional shares. So, hey, there we are, everybody. And the total market in the last 5 years, it's up about 12% a year. I'm actually up about 11% a year, so I'm lagging the market. But if we have something to do, some sensitivity around AI and valuations, my positioning in VTV, VBR, as well as healthcare, um, large dividend and some international exposure should help me to outperform or uh, continue with market performance. I see that I'm capable of essentially replicating the market with a lot of extra steps, but it's a lot of fun and I certainly make money. It makes me more engaged.